And Michael Harris, great to meet you. Welcome to F.A.C.E.
Okay, hi. Let
How are you?
me open. How are you, Coach? Everything
Oh,
okay?
yeah, everything's good. Very nice to meet you. Glad that.
How did you end up getting so many Greeks in the same room? Now one more.
Oh, okay. Yeah, Harris. So it's Harris is your yeah, Americanized name.
Yeah.
Okay. All
You
right.
bet.
So
You
yeah,
bet.
Steve and Stelios, they're partners of
Yeah.
ForexAnalytix.
I hear. Good people. Good
Yeah.
people.
Okay. Yeah. I have Opa. That's all I could say. Opa to
Opa
you,
Uzo.
Michael.
Opa Uzo.
So
Okay.
all
We
right.
got a surprise number, right?
Yeah.
Uh,
Do you want to share your screen?
yeah. I will share the screen.
It's on the bottom.
Yeah. I saw it.
There it
Do you
is,
see
Mike.
that?
Yeah, got your slide up
Yeah.
there. So,
Yeah.
Michael, before we get to the markets, and
Sure.
I went to your blog, Price Action Lab,
Yeah.
and looked at your blog, and I'm in and read a little bit about your history. Can you tell us a little bit about your journey early on,
Okay.
and did you start in the industry in Greece?
No. I
Okay,
migrated to US when I was so very young. I put a short bio.
I see it.
The slide.
Okay,
I I studied initially mechanical engineering and robotics, and I
okay,
worked for several years in the field. And then at the same time, I was studying at Columbia for my financial engineering degree. When I finished, I started working for fixed income.
okay.
I had no
Bond
idea
house.
about trading, doing analytics, portfolio optimization, and stuff like that.
Okay,
You probably know, and then at that time, someone I knew asked me to backtest a trading system for currency futures.
okay.
I had no idea what currency futures were for trading because I was in fixed income, but I did that, and we thought it had some potential for trading. So he convinced me to open an account with, do you remember the Oppenheimer firm? Yeah, the Oppenheimer.
Oppenheimer, sure, of course.
Yeah, in a World Trade Center. We opened an account there with a very nice broker, and we traded. It was a trend following system, double moving averages. You're probably aware, envelopes.
Yeah, okay.
And we made lots of money in 9 months. I remember it was my sister's birthday on November 8th, and I said to him, let's close the account. This can only be luck, because we made a huge amount of money trading these currency futures. He said, I want to start a fund to trade, I have people to invest,
Right.
with me. I said, I'm going to trade other people's money. I will take my cut, and I want to go to California to see some relatives, because my father's family had migrated to Sacramento many years ago, and I'm gonna stay there. I like the outdoors, and I took the money and I left, and I found out 2 years after that the fund went bust.
Yeah.
Because it was luck.
Yeah.
And
I'm not against luck, but you just like hope, you can't count on it.
Oh no, you can count. You have to have experience, discipline. He was not disciplined. He didn't have experience even with treating the data. I mean, he wouldn't adjust for rollovers in futures. I mean, you can do these things. And I started working for a commodities firm. They were doing also trading in New York. I went back to New York because at that time, you know, there was no place like New York in the whole world. You know that in the 90s.
Chicago was better.
Chicago, yeah, I used to go there too.
If you're a commodity trader, the exchanges in Chicago better.
But for stocks and fixed income, that was in New York, So, but also I'm talking in general in terms of lifestyle. New York was great, so I went back to New York. I was doing forecasting for freight rates and commodities and also trading. And I started working on a data mining program to find anomalies in price action. And I started working on this, and that was the mid-90s. And by 2000, it was working well. So I decided to start selling the program to a few people around the world. I was amazed at, with the interest people had. So I started this business, and in 2010, I started my blog. And I provide analysis for a few clients, and I also have a systematic, you see, I'm more on the systematic side of things. I appreciate discretionary traders, but for discretionary, I only like the quant discretionary aspect.
All right. Why don't you define what a quant discretionary is?
Doing validation, so statistical analysis of the signals before taking them.
Okay.
Not a visual analysis type of thing, but I realize there are many people like you, for example, who are very, very experienced with the old school TA. Yeah. The old school TA. I call them type 3 people in TA. The type 3 people are very experienced, but they are few. I am saying a young person that starts now with TA, it will take many years to reach your level, right? Yeah. You agree with that?
Yeah, I would say, yeah.
And the tuition is high.
I'm still trying to get the hang of it.
Well, yes, but the tuition is high, and markets have changed. Markets are more difficult right now for this type of trading. You have to be very experienced. So anyway, can I go to the next slide?
Yeah.
Well, I have a disclaimer, standard, you know these things.
Yeah, sure.
I use data from Northgate Data in Australia, a very good vendor. I'm not a sales representative, but I will tell you if you need data, this is a good place. And I use AMI broker and R language. Okay. Now, this is how long do you want to make this? I skip some slides if you.
Okay, I like that. I said that, yeah. The first thing people have to do as a trader is learn how to survive.
How long do you want this presentation to be?
It's up to you. We have another.
Okay, I'm gonna try to make it. I don't want people get bored because this is like introduction. Many people are experienced. Yeah. We do this mainly for the new people. There, okay. For the new people to try to warn them. The experienced traders, they want to maximize wealth because they have experience, the Sharpe ratio, the MAR, and the beginners traders, What do
you mean by final wealth?
The final wealth accumulation, how much money they make.
Okay.
Sometimes they don't care about drawdowns because they are experienced. They can survive. They can use martingale position sizing, like in the casinos. Okay, those are the experienced traders. The Nick the Greek.
Right.
Okay, but the beginner traders, they should Be disciplined, trade small to stay in the game for several years, maybe 5 years, until they gain experience. But most beginners, they start with no humility, and they think they can make money fast, and they lose it everything. So this is what they should do.
You mean you can't buy a book and read it over the weekend and do brain surgery on Monday?
Or use chat GPT. No.
Okay.
No, you
All
can't.
right, well, I want to get to a few things that I read. It looks like you have some proprietary indicators like DL PAL. Why don't you talk about that?
That's a software. But let's talk. Yeah. Do you have any question, or can I continue?
Okay, just go ahead then.
Yeah, I mean, for every type of trading, whether it's systematic, which is my style, or discretionary, like I understand is your style and other people in the group, you need a trading edge, which is the subject of this presentation, because the risk and money management is very complicated, and discipline is even more complicated, because it has to do with psychology. Yeah. And there are many disciplined traders out there who lose money because they don't have an edge, and they overtrade. They don't use proper risk and money management. The discipline is necessary, but it's not sufficient. Okay. We agree?
All right. Yeah, you still have to be right and have a decent hit rate.
Yes, you have to have it. And now we are going to the hit rate. You are front running me. You are front.
Well, I'm Forex Stop Hunter. I've taken you out already.
Yeah.
You've been knocked out of your position, and I.
You hit my stop already here.
Yeah.
Now people say a systematic or discretionary strategy that has a high positive expectation given by this formula, that's the edge, where, the average win and the average loss we multiply by the win rate and the loss rate. This is the edge. Okay. And you can find this in many books, papers, and podcasts and everything. And I'll tell you something, because this is the most important thing. This is false. This equation that these gurus, they have in their books or papers, is not the edge, is the problem. And I will explain why. Because this equation is not the expectation, what you expect to make in the long term, but it's the average trade. And, very simple proof here, very simple proof that this equation is the average trade. Continuing?
Okay. Yep.
Okay. So what is the expectation, the edge? Is very important for people to know what is the expectation, because if you know the expectation, you multiply by the number of trades you make, and that's your profit. Okay? The trading expectation is given by this formula, and this is actually a complicated formula. T is the trade profit loss. How much you made today, trading silver or gold, of the ith trade. Today is the ith trade, and P is the probability of that trade. And we don't know the P's of the probabilities of the trades, and we don't know the future trades. So we don't know the expectation. We never know the expectation. That means we never know our edge. So whoever is talking about edge, they are talking nonsense. only the citadels and the high frequency traders know the edge. And the market makers who make the bid ask spread. The traders, they don't know the rates. Okay, so
you're saying the guys that like Schwager wrote about in Market Wizards and New Market Wizards and Unknown Market Wizards, which were all successful over time, in fact, legendary, or a guy like Richard Dennis, he didn't know he had an edge.
No, he didn't know his edge.
He thought he had an edge, but he really didn't have an edge.
Okay, here we have the problem of skill versus luck. And we had so many commodity trading advisors, and a few made money and survived, and they may be the outcome of survivorship bias. We don't know that. Because when you have a large population of random traders, and I make these simulations all the time, some of them will make a lot of money even consistently by luck alone, okay? So we don't know who has the skill and who has the luck. And we know many of those that started with Richard Dennis, they fail. Like, for instance, Jerry Parker has done very well over the years. You know Jerry Parker?
I don't, I'm sorry.
Yeah, he has done very well. He was in the original Turtles program. But some of them...
So was Linda Raschke, wasn't she?
No, I don't think she was there, but I know she's a good technical analyst, and she has written some books. But let me continue with this. Okay. The fundamental problem of strategy, evaluation, and trading is that the average of the trades converges to the expected value, the expectation, at the limit of sufficient samples. And this is why we always say an experienced trader may have already a sufficient sample, but new traders, beginners, they don't have a sufficient sample and they don't know what to expect. It's simple. It's statistics, basic statistics. They don't know whether their method will provide a profit. Okay, and here, what I'm saying is that a trader can hit anchor point or even ruin before the average trade converges to a positive expectation. And I have some papers I have written about this. So let's go faster. An example, you toss a fair coin with a win fraction of 50%, 0.5. Heads win $1.10 and the tails lose $1. And everyone says, oh, this is fantastic. I'm going to make money. The expectation is a nickel. Okay? Mm. So you see here that the average trade makes a dip before it converges to the expectation, and it takes long. It takes more than 800 trades to converge. If a trader is not disciplined and does not exercise good risk and money management, they get ruined before the expectation, the average trade converges to the expectation, and this can happen also because of undercapitalization. Okay?
Or over leverage.
Over leverage. I mean, you know these things, and my presentation is for people who don't understand these things. But there are also lucky players. Here is a lucky player. This player builds a cushion before the average trade drops negative. And also this was the case with back in the 90s when I started trading the currency future. You know, we made money, but if you stay in the game, you lose because you don't have the experience to deal with the non-stationarity of the market. Okay, so there are lucky people and unlucky people. What makes a difference? The discipline and the risk management. That is what makes the difference. And in one of my books that was published by Wheeler in 2008, instead of the expectation formula, I used the profitability rule. And I use P for W, the win fraction, in this equation. The win fraction is the profit factor divided by the sum of the profit factor plus the payoff ratio. And this is an extremely useful formula for beginners, especially to understand. It gives you the lower bound for your win rate to survive if you know your payoff ratio, especially if you are a discretionary trader, okay? Mm-hmm. If you risk $1 to make another dollar, then your win rate should be, rather win fraction should be greater than 0.5, okay? So, and here I jump, there are two basic types of trading strategies, systematic or discretionary. You have the convergent, which are the mean reversion, statistical arbitrage, seasonality, and others. And you have the divergent, trend following, momentum, the macro strategies, the hold, buy and hold, and others. Now, even with technical analysis and discretionary trading, all the signals, they fall under these two categories, which I don't like myself. I don't like this classification, but it's okay, okay? And the convergent strategies, they have a short-term horizon, and they are based on price action inefficiencies or anomalies, like you talked before in the room about the price action in the currencies. They have a higher win rate above 60% and a low payoff ratio below 1, and short holding periods, 1, 2, 3 days, maximum 5. The divergent strategies are the trend followers. They have low win rate, but a very high payoff ratio. Okay, there is an overlap, but this is another story. Now let's go to the profitability rule. If you have a payoff ratio of 5, you are making 5 times what you lose on the average, and the profit factor is 1, that means break even, you need to be at least 70% profitable. If you have a payoff ratio of 2 and you need a profit factor of 1.5, then you have to be nearly 43% profitable. And if you have a payoff ratio of 0.5, like in mean reversion, it comes close, to have a profit factor of 2, you need to be 80% profitable win rate. That's a lot. That's a lot. Okay, that's why many people prefer to trade long-term or become buy and hold investors, because for short-term trading, it's very hard to have these high win fractions unless you can increase your payoff ratio, which is also difficult because of stop hunting.
Those guys.
Excuse me there?
those guys, those stop hunters.
Yeah, stop hunting. It's the job. Okay, it's the job. The market, whoever complains about the market says, "Oh, the market is manipulated. Oh, they hit my stop." I wrote those in my books. They shouldn't be trading. They shouldn't be trading. Every time you input a trade, you may be hitting someone's stop. So what? You are a stop hunter? I mean, let's clarify this. Now, this is an example of our proprietary PSI5 algo for a convergence strategy with daily data. We trade long only the SPYs, the diamonds, and the small caps. Win rate is 66.7, payoff ratio is 0.72, the annualized return is 9.9, average holding is 4 days, no stops. And this backtest has 2,462 trades. Now, the convergence strategies are risky because they have no stops, okay? If a flash crash occurs,
they can be
the trader may be ruined.
Yeah.
The trader may be ruined. Now, the divergent strategies, this is an example of 100-day breakouts. It's a very simple system. Now, divergent strategies are very simple systems. Moving averages, crosses, breakouts, Dogian channels. This trades 23 liquid futures, and it has a win rate of 23%, but a payoff ratio of 5.8. Look, the other one was like the payoff was 0.72. This is 5.2. And the annualized return is 12.8%. The average holding is 79 days. It uses stops. It does that with the average true range. And that's 1,250 trades. Now, the problem here is you need to be very disciplined to trade a system with a win rate of 23%. Very, very disciplined. There will be 10, 15, 20 consecutive losers. And not too many people can take it psychologically, and they quit.
Yeah.
And they quit. And this is an example of discretionary, that's our DL-PAL DQ anomaly detection program. Now on November 7, last year, we scan 32 ETFs, and we get some that have the potential to generate signals, long or short. But you see, the trades are not enough. We need to validate. That's why I said the quant discretionary trading needs validation. For a old school TA person, the validation is experience. Do I make any sense?
Yeah. And we're running up against the clock now.
Yeah, exactly. But for when you analyze data, the algo doesn't have any experience. You have to validate. So how do we validate? We test the signals on all 32 ETFs, okay? Every signal. So now we increase the trades to thousands of trades. And here we got a signal for the diamonds for short. Now, when I saw a short signal in Qs, it was strange. It had a very high, high expectation. The portfolio expectation was 0.17. So, I put that on Twitter. Next day, the diamonds the short gained 2.2%. Now, this is, of course, selection bias. I showed you a good example. There are also bad.
Okay, so let me ask you this. Let's get to the guts of it. What's your business model? Are you looking for people to subscribe, and who are you looking for to work with? Or do you just have a few, like you said, a few exclusive clients, or do you manage money? Tell us what you do.
No, I don't manage money. I have a blog. I provide analysis for a few people. I don't have, a very big crowd, but I have a loyal crowd. Some people are with me for many years, and I provide systematic signals report every week. Those are weekly reports, premium articles, and
So
also
so it's a subscription. You have a subscription for
subscription, yes, subscription. And I'm grateful to my customers because they have supported the work. And if you provide the subscription service, first of all, I don't do any hype, and I don't promise any returns. It's just an analysis. And if you are not good, you don't survive too long in this business. This is what I do. And I have the software. The software, I have clients in Asia, Latin America, and in many places around the world. And they use the software as another tool for their analysis. It's a tool.
Right.
Okay.
Got it.
It's a tool.
We have to wrap now, Mike.
Yeah. We are. I had some more slides, but about the markets, but we are already. Okay, so this is what I do. I have, let me go to the last slide, how to find me. I have made a page for this webinar in my blog. Here is the link, and you can get my free book, Profitability and Systematic.
I like your book title, Fooled by Technical Analysis.
Yeah. Well, that's on a subscription basis, but fooled, it's for people who get fooled. Some people misunderstand the title. It doesn't mean that technical analysis fools you.
It's a beholder.
Yes, exactly. Some people let themselves get fooled by technical analysis because they don't understand it.
Well, people sometimes have to make a choice and pay their dues to become an eagle and stop being a pigeon.
Yeah. I like your morning prayers, by the way.
Oh, thank you. I noticed you enjoy it. So, this is, for people that have an affinity for what Mike does, check him out. And
I know not too many people are in systematic and quant discretionary trading. The audience is small.
Yeah, well, I say, you know what, Mike, I say keep an open mind. It will keep your account open.
Yeah. And this is how they can find me, and in Twitter, in my blog, and the book is free. It was published by Willie, and it's free. They can download the PDF. It's an introductory book, but has some, I believe it has some good information for both beginners and experienced people.
I appreciate your giving spirit and coming here and taking the risk of talking to me for a half an hour or so, Mike, and you're now my trading warrior brother.
Oh, thank you very much. Thank you for having me, and I wish you good luck with your trading, and to everyone in the room, and to all Greeks, and all peoples of the world. We are all the same. Yes. And thank you very much.
It was a pleasure meeting you. Glad our paths crossed, Mike.
Thank you. Have a nice weekend.
All right. That's a wrap, everyone. Hope you enjoyed the week. We laid it all on the court for you. get recharged over the weekend, and we'll do it again next week. And don't forget, don't just count your systems, your methods, count your blessings.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.